Hello guys, welcome back once more again to the MikeMoney Fx trading platform, Expertroborex. So today basically I'll be teaching you the most successful manual trading strategies that we have out there and that has been proven to be very successful over a period of time, over a period of years basically. So pay attention while I take you through the most successful manual trading strategies. So most of you must have watched my previous videos and you realized that the trading market hacks works very good and also very difficult to trade the market hacks using a manual method, that is trading with your phone. And because of this difficulty, a lot of people cannot trade the market hacks. So what other strategy can you trade in the Forex market or the crypto market and make good money? So as much as we already have market hacks, we have trading robots that trade the market hacks. Also, a lot of people prefer to use manual trading strategies, just like a lot of you prefer a manual car to automatic cars. So what has failed over the years of trading? Yes, there is a strategy that has failed back to back consistently, and those are indicators. Now, a lot of you must have come across what is called technical analysis. One of the forms of technical analysis is indicators. Indicators can be used to predict the market according to most professional traders, or what they call crypto or forex acclaimed gurus. But the truth is this: if not all, I mean almost all indicators in the market, if not all, are less than 70% accurate. In fact, the best of indicators that I know in the market are 68% accurate. And to worsen the situation, let me bring it to your notice, your information, that indicators are not equal to market predictions. So don't get it twisted. If you watch almost all the videos I've posted, almost all my trainings, I've never emphasized on the advantages of indicators. Indicators is the only thing that I have never emphasized or talked about, because indicators are only indicating the current situation of the market, not the future prospective direction or prediction of the market. It indicates the current situation in the market, not the future situation in the market. This is why indicators have not proven to be successful in predicting the market direction. So generally, what is a trading strategy? Most of you have heard me use this word separately, and possibly you do not understand what a trading strategy is. Yes, a trading strategy is a trading method. Basically, what it means is, for you to trade the forex market, you have to look out for certain conditions, and when those conditions meet, you take your buy or your sell. You cannot just randomly go into the market and click buy or sell. No, there are conditions or market situations that could possibly predict the next market move or next market direction. So putting these market processes together, these market processes that help you predict the next market move, is called a trading method or a trading strategy. So basically, when you are using a trading strategy to trade the forex market, you're actually following a repeated pattern with a specific approach, and it now gives you a trading strategy. So basically, what are you doing? You're actually using a systematic method. You are following a systematic method to trade the forex market. That is what you are doing. And for your information, there are over 1,000, if not 10,000 or 100,000 different trading methods out there in the market. The most popular of them is indicator-dependent trading strategies or methods. And guess what? They fail. This is why 99% of the videos on YouTube cannot make you money, whether you are in forex or crypto. Because they only relate to you. They relate to you indicators, and indicators cannot sustain a successful forex trader. This is the gospel truth. So what do we do? Is there a way out? What is there the possible most successful manual trading strategy out there? It's called the market structure. There's a combination of market structure, candle patterns, and news filter. If you put these three together, the market structure, the candle pattern, and the news filter, you will always penetrate the forex market using a manual method, a manual trading strategy with your phone or your laptop. The most conducive pattern to approach forex trading successfully is by using the market structure on your laptop. It is very consistent. It has been proven to be very consistent. Now, what is market structure? A lot of you do not understand the meaning of this word market structure. Yes, what it means is this. Whenever you open the forex market, you see a chart that shows candles or sticks going up and down. For your information, these sticks are following a well-defined pattern. History studies have proven that the forex market, the crypto market, has a specific pattern it follows. It is like a roadmap. It has a well-defined roadmap it follows. Right is up or down. Now, if you are able to understand the roadmap, it means you know the next direction of the market. So don't get it twisted. I've used the word probably defined or specific trend pattern. I use the word probably because it is changeable, in the sense that the market can have a defined structure today and tomorrow it will restructure into a new structure. But the truth is this: it always follows a specific structure, whether you like it or not. It can have one structure today and tomorrow it will redefine that structure and continue with a new structure. But there is a basic structure, a fundamental structure the market must follow. I will teach you the converting or changing structure. I will also teach you the fundamental structure which the market must follow. So there's a structure the market will follow. There's a structure the market must follow. There are two major structures: a structure the market will follow and a structure the market must follow. It must obey that roadmap, whether you like it or not. So when you talk about market structure, it's similar to star patterns or star constellations. I think most of you are hearing this word for the first time. What's called a star constellation. Yes. When you look at the sky in the night, what do you see? Most of you see stars. But if you are a professional astronomist, you will see something like this. You see patterns. You realize that the stars are not just arranged randomly. The stars are arranged in a specific order or specific pattern. So a random common man might not recognize this pattern. But if you are a professional astronomer, you might understand this, or astrologist, you might understand that this is a specific pattern. And the patterns have names. Look at it. You can imagine three stars It's forming a scuto. You can see how many stars are arranged in this format. It's called Aquila. When the stars are arranged in this format, it's called what? Capricorn. So if you don't understand that this regular arrangement or structured arrangement has a defined name, you will not understand that even the stars are not randomly arranged. They are structurally arranged and they follow that specific structure. Look at the Libra and look at the Scorpions. Alright. When most of you look at the Forex market or the crypto market, you see candles. You see candles going up, down, up, down, up, down, up, down. You just see candles. But when a structural market analyst, when somebody who is a market structure analyst looks at the market, what he sees is defined patterns. He's seeing that the market has a downtrend, hits a support level, is most likely to come back up, and it hits a resistance, it confirms the resistance, go back and hit the support, comes back again, goes back, hit the support, gains enough momentum and shoots up and breaks the resistance level and goes and forms a new resistance level up there and comes back. And as it's coming back to the former resistance, it uses the former resistance to form a new support, goes back up, hits that newly formed resistance level, obeys it, comes back a little bit, confirms it, and goes back and breaks that resistance level to form a new resistance level on top, and is coming again to convert the former resistance level to a new support level. You can see all of that movement. When a market structure analyst looks at the market, this is what they see. They see a structure market following a pattern, a regular pattern that can be well defined, and the market will follow that pattern consistently. So your ability to define this pattern is what determines your success in trading the market manually. Your ability to define this pattern. See this pattern you are seeing here, this up, down, your ability to accurately define the next move, following the patterns is what determines your success as a manual trader, So what are the general market trends? Uptrend, downtrend, ranging. Yes, this is it. You can see this is up, going up, coming down. But when market is going up, does it take a straight path? Answer is no. When market is coming down, does it take a straight path? No. If market is going up, it goes up small, comes down small, goes up well, comes down small, goes up well, comes down small, goes up well, and it's getting exhausted, it comes down. Instead of going up well, it goes up small, comes down more, goes up small, comes down more, goes up small, and comes down. So you realize that when the market is going up, it is making a more up movement than a down movement, which means the up pull momentum, which is the bulls pulling the market, are stronger than the bears. So you expect it to move up. You can see it is moving up more. The up arrow is higher than or longer than the down arrow, which means it is moving up more and moving down less. That means the market is actually moving up. It's called an uptrend. And this uptrend is not just going straight line, it goes up more, like I said, and comes down small, and pushes up more again, comes down small, and pushes up more again, comes down small. Now, as it goes up more, it hits a level called higher high. When it comes down small, it hits a level called higher low. When it push up high again, hits a level called higher high. It comes down to the higher low, goes back to the higher high, and comes down again. Now, if it has not broken, the word broken means it will come below There are two levels of there are two definitions of the word broken. It can come below this higher low. You can see that the one thing you must understand about an uptrend is that the successive higher high is always higher than the previous higher high. The successive higher high is always higher than the previous higher high. Same thing with the higher low. The successive higher low, which is this one, it will be higher than the previous higher low. The next higher low will be higher than the previous higher low. That means the uptrend. There are two identifications of uptrend. The higher high, the new higher high will be higher than what? The old higher high. The new higher high higher than the old higher high. The new higher low higher than the what? Previous higher low. The new higher low will be higher than the what? Previous higher low. That is how you know this is uptrend. How do you define this as downtrend? The same thing. On downtrend, use the word lower high and lower low. Now, the new lower low. Look at the new lower low here. It will be lower than the previous lower low. And the new lower high will be lower than the previous what? Lower high. This is how you confirm this market is now what? On a downtrend. Whenever you look at the market, whether you are a long-term trader, short-term trader, you are into swing trading, or you are a scalper, it is good you can easily identify the trend of the market. The first question is, where is the market going? Is it going up or down? You should be able to easily identify this on what is called the higher time frame and the lower time frame. The lower time frame is the highest momentum time frame of the market. So whatever you are trading on lower time frame, you must go to the higher time frame first, confirm the highest momentum in the market, come back to lower time frame and follow that trend of the higher time frame. It's easier to make money in that form if you are a manual trader. So you can see that there is always a uptrend market, a downtrend market, or the market could be what? Ranging, what is called sideways. It's not going up, it's not coming down, but it's maintaining a certain level. Goes up, down, goes up. So it's not actually in the up movements or in a downtrend, but it's called a sideways trend. So you can see a very clarified category of this trend. Now this is the higher low, and it goes up and forms a new high. It comes down to the higher low. Now it's going back up. Are you seeing this? This is the beginning of an uptrend. Why? The uptrend has showed us at least two higher lows. So it means that for you to confirm the market is going up, make sure you have a minimum of two higher lows and at least one higher high. If there's one higher high, two higher lows, it means we are going up. Am I communicating? It means we are going up. The same thing will happen when we are coming down. This is start of the downtrend, but to start, you confirm that downtrend with the two lower highs, 1 and 2, and one lower low. So this line should be here. That's where you confirm it. Somewhere here. So the moment it breaks this and comes up, as it's breaking, just know that it's going for the next high. Don't forget, this high is higher than this higher high. As it hits this higher high, come down to where? The higher low. As it hit the higher low, to go and break this level, this new level again, to break this new level and come up again to form a new one, higher high. When it does that, it comes down again to form a new higher low. To go up and break this old level again to form another higher high. But guess what? It has come down to a new higher low. But when it was going back up, it did not break last higher high. Are you seeing it? Instead of breaking the last higher high, it has reversed in between and come down and broke the lower low and broke it well. It did not break it, broke it well and continued. Which means it's trying to create a trend. It's trying to reverse. So from this uptrend, it's trying to go in a downtrend. Are you seeing it? So because that's broken, there's a way we confirm this breakout. Because now it has come below the previous higher low, which means it has broken the principle. The principle is that the previous higher low, sorry, the new higher low must be higher than the previous higher low. So if it comes there and comes there and still goes back up, it has reversed, it has broken that principle. You must now understand your new entry properly. You must first define the new trend before you enter the trade again. Now it has come down, created a new lower low, went back up small to create a new lower high. You can see definitely it's coming back again and breaks this previous lower low. It's going on a downtrend. Sure. You can see that happen. So you must follow the basic principle to clearly identify a trend and understand where you have a reversal, and clearly identify and isolate both the trend and the reversal. So this is another clear example. You can see that it has formed the resistance level. Now I'll explain this resistance level in detail now. Now, one thing you must understand about the forex market, like I said, or the correct crypto market, is that it follows a defined pattern. Now, let me give you an example. See, a resistance level is defined when the market goes up, hits this level, comes down, goes up and hits that level for the second time. You can call that a resistance. But if it is coming down, hits here for the first time, hits here for the second time, you cannot call here a support. So if the level is below the market and it hits them more than twice, it can be called a support. If the level is above the market and the market has hit there twice and returned, it can be called what? A resistance. So the resistance and support levels are reflection levels of the market. When the market hits them, the market is likely to reflect, it's likely to reverse on hitting either the support or the resistance level. So here the market acts as a support. Now it has broken the support, it bounced off the support, came back and broke the support. On breaking it, you can see it created another support here. It came up and hit it, and of course it has hit here and it's coming down. Like I said, the market is now below this level of reflection level. Here now becomes a resistance. So a support level now can be a resistance level tomorrow. That's why I said market structure changes. It changes. So you can realize that a former support level can become a new resistance level, or a new resistance level can become a support level. This market can go up above this level and hit here again, twice again, and even in the next future here becomes a new support level back again. It's very possible. Now, this is a clear example of a downtrend. You can see the market follow a downtrend. How? You can see sell candles. It takes an up small trend. It comes down again, up small buy, down again, which is huge sell. Let me explain that again. This is a huge sell, small buy, huge sell, small buy, huge sell. So the sell is more than the buys, and that's why it's moving down more on the average. On the average, it's moving down more. You can see that happen until it is trying to take a reversal. How do you know it's taking a reversal? Now, this is what is called what? If you look at the previous, it's called the what? The lower high. This is the lower low. So this is the lower low. It goes to the lower high, comes to lower low, goes to lower high, lower low, goes to lower high, lower low. So if you observe, like I said, the lower lows, which is this, is lower than the previous lower low. Same thing as this. This is lower than the previous lower low. This also, the lower high, this lower line is lower than the previous what? Lower high. Same thing here. This lower high is lower than the previous lower high. Now, after hitting this lower high, it comes to a new what? Lower low. It's supposed to go up to what? A lower high and come back to a lower low. But instead, it goes up and breaks this the previous what? Lower high. It breaks it. So breaking it means it has changed the structure now. It's about to create a new structure. Pattern of lower highs and lower lows was broken here. So when it is broken, it is now left for you as a market structure analyst to now redefine the new market trend. Where is it going? That's the next question. Is it going to go up or down? Another clear example, you can see resistance levels. I've explained resistance levels and support levels. And you see, when I told you whenever the market is coming from up, hits a level and it's going down, that level becomes resistance level if it hits it twice. If you hit it once, we cannot confirm it. So on hitting here the second time is when here becomes a resistance level. As it hits here and it comes down. Yes. But if you hit it once, we cannot confirm it. Is that well understood? The only way you can change a resistance level to a support level is if instead of the market coming from up, hitting it and going down, the market is coming from down, hitting it and going up, so that resistance level becomes what? Support. Same thing happened here. In the next, you watch, they did show the next phase where this came down and hit this level to form a new support. So you can see the market coming down trend. It ranges or consolidates, then goes up and breaks this resistance level, pulls up into high momentum, comes down again, confirms this level to a support now, converts this level now to a support and moves up again. After confirming here to be a strong resistance level, it breaks it again and goes up again. Now this is now a new uptrend here. It comes down again and goes up again. So you see that. So this is a clear example of structure, market structure and the candlestick. Yes, like I told you, you have a good market structure, you combine it with candlestick confirmation, you have a good entry. And you can also use that to detect what's called the fake out. The fake out. So when we first of all identify we learn how to identify market structures, we'll now learn how to identify fake outs. Then we'll combine it with candlesticks and use it for good entries and trade. So you can look at this. This is an uptrend. You see an uptrend, higher high, higher low, goes to higher high, higher low. You can see that happen here. Clearly, you can see that happen here. Are you seeing that? So when you are looking at this market, this is the market you are seeing. But this is the structure of that market. You can see a conversion of this market into its structure. This is not the structure of this market. This is the same thing you're looking at here. But this is the interpretation of this here. So on hitting the higher low, it goes up to a new higher, which is there, higher high. It comes down to a new what? High low. Goes up again to a new what? Higher, which is there. On coming down, it now breaks the previous higher low, which is what? Which is here. Look at it. It has broken that level. That level is here. Look at it. It has broken it. On breaking it, it still comes back and obeys. Look at it. It comes back again. So you must understand what is called fake breakout. Most people think it's a downtrend. It's a possibility. And it comes here and breaks here, it goes back up. Now, since that's broken it means that's broken what? The uptrend. The question now is, will it form a downtrend? Now, on going up, it goes to form what? It goes up here. We are expecting it to form a what? A lower high at this spot. A lower high, because this spot did not come above the previous higher high. So if it stops here and is coming down, it's most likely to be coming down for a sell zone. So you can enter it at this spot for a sell. That's why it's called a sell zone. But if it went up above it, is likely to continue that uptrend, or it is rearranging the market for a new structure. If it went up above the previous higher high. So, like I told you, if it went up above the previous higher high, you are expecting that to be the new what? Higher high. Because the principle says the new higher highs must be higher than the old higher highs. And the new higher lows must be higher than the old higher lows. And the new lower lows must be lower than the previous lower lows. And the new lower highs must be lower than the previous what? Lower highs. This should be a general principle for you to identify a trend. So there are other major patterns, quite a good number of them. You can see them here. I dropped a link where you can find other patterns, what is called the Forex springboard. So to give you different chart patterns, you can just scroll down. I have a good number of them here that are general patterns. Please understand these patterns, so whenever you're looking at the market, you can clearly identify these patterns. And you see that when you identify a pattern, you can now identify the next move. This arrow is telling you the next move of the market. If I identify a pattern, it's telling me the next move of the market. So for every pattern, it is telling you that this is where the market is going. So it's important you have this knowledge. This knowledge will give you the fundamental principle to succeed in either you are trading Forex or cryptocurrency market. So on our next lecture, I'll be teaching you how to identify the market structures and also plot the market structures and use it to predict the next market move. Then I'll also teach you a different, absolutely new strategy called the 5% daily profit strategy. You don't need to trade, you don't need a trading robot, you don't need signals, you don't need any skill, and there's absolutely no risk, and you can still make 5% profit every day, because this channel is all about making money off any system that has the ability to give you wealth. So basically, you can take advantage of that video as well, called the 5% daily profit with ease with your phone. It is actually that easy. You don't need no form of trading skill or robot or risk. You have no risk whatsoever. You can just be in the comfort of your home, make these decisions, and close the day in 5% profit with absolutely no stress. All right, thank you very much and have a nice day. If you have enjoyed this lecture, please do well to subscribe to this channel, like this video, and share it to your loved ones and your family. Thank you very much and have a nice day. Bye.